You probably noticed a lot of what we buy is getting more expensive. The Labor Department reported Thursday that consumer prices jumped 5% over the past year. That's the highest inflation rate in the U.S. since 2008. It means Americans are seeing higher prices on things like food, clothes, and lumber. To provide context for those numbers, I want to welcome Gwynn Guilford, an economics reporter for the Wall Street Journal. Welcome, Gwynn. This is actually, last year at this time, much of the country was in lockdown due to the pandemic. I'm wondering how that affects year-over-year differences and if that is contributing to this spike now.
It's definitely contributing to a lot of this spike. For some goods and services, the prices drop so much that they have to grow crazy fast just to get back to where they were pre-pandemic. So, for instance, if you look at the year-over-year increase in airline fares, it's up a pretty shocking 24% in May. But then it's still down 12% from February of 2020, so just on the eve of the pandemic. So yeah, that what economists call the base effect is contributing to what looks like really kind of maybe even scary high inflation. But there are other factors too. As the economy reopens, there's, consumer demand is picking up crazy fast, and that's kind of outstripping the ability of businesses to meet that demand. So you have shortages throughout the economy, and that's driving prices higher.
So certainly we're seeing that in travel and leisure, but I'm wondering if there are other specific sectors of the economy that people that aren't as discretionary that are seeing bigger jumps in prices.
Yeah, I mean, the price increases are maybe not precisely broad-based, but they're definitely, it's not just isolated to the hardest hit sectors, although those are definitely driving up the headline price index increase quite a lot. So, for instance, these are still consumer items, but the household goods like appliances are up a lot. Furnishings, indoor plants, all up a lot. And that's, that might be driven by the housing boom that is still going strong. So, there are a lot of factors going on right now, a lot of kind of strange pandemic dynamics that are happening that make it a little bit hard to tell what is really the most important question right now, which is like how much of this is temporary and how much of this is giving way to a more persistent shift into higher inflation.
That's helpful framing, Gwynn. Along those lines, what do economists consider a safe level of inflation, and what happens when things get too high or too low? But that's not really the problem we're looking at here.
So the Fed targets an average percentage or average inflation of 2% over a period of time. That's sort of the sweet spot. There are a lot of economists that think that it can go higher, 3%, maybe even a little bit higher than that. There are some economists who think that any amount of inflation is not that great. What you don't want is accelerating inflation. And so that what you're trying to avoid is sort of a wage price spiral where people see prices going up, so they demand raises from their employers, and then their employers raise prices because their margins are getting crimped, and then people ask for even more money. So, and that just kind of builds on itself. It's a self-reinforcing dynamic, and when that gets underway, it could be hard to control, and that could have all sorts of negative consequences. The market, you would definitely have market turmoil. The Federal Reserve would have to raise tighten rates faster than expected, that could hurt business activity and spending, and the housing market, and in general, it just that fast rises in prices cause uncertainty that makes it hard for businesses to figure out how to invest. So it can contribute to sluggishness.
But I want to follow up with you on this point about wages and the potential for snowballing inflation, because we have been talking to a lot of employers who say that they have not been able to find people to fill, particularly entry-level or minimum wage positions. Do you expect to see then wages continue to increase and the effect that that will have on continuing inflation?
Yeah, this is a really important part of the inflation picture right now, and it's getting a lot of attention, but it's very complex. It's very hard to tell, what you should be looking at to know whether wages are sort of in aggregate going up, because you have all these anecdotes of, Amazon or Walmart raising wages, but you don't know how broad-based it is, right? And the thing that is a lot of small businesses are reporting, there's a record high 48% are reporting high, like not being able to find qualified workers. So there's some sense of mismatch going on, and it's just hard to find the right people. It takes time. And so that's going to be a natural thing, that the problem as you try to ramp up the supply side of the economy. But the other problem is, like, people don't seem to be coming back to the workforce quite the way many economists expected. And, we'll see in coming months whether the cutting off of enhanced unemployment benefits induces people to rejoin, or whether, when schools open September, that allows people to rejoin. All these are really, really important questions. But, another key part of this that we don't know now and we'll be figuring out in the months to come is, like, is the wage increase happening right now? Is that sort of a one-off, like an adjustment as we go through this reopening process? Or does that start to become a cycle that kind of builds on itself?
Lots of important questions. Gwynn Guilford, thank you.
Thank you.